Hello, everyone. I hope everybody is good today and healthy. So we are starting actually, we already finished the subject related to the NPV and the different investment criteria, and we just moved to, let me just share the screen with you. So we talked about the popularity and the usage of the capital budget methods, and we see that the conflicts of the selecting the different project. So we had some issue with the other investment criteria except the NPV, and the last thing that we underlined that the NPV is the best investment criteria and is the superior to other investment criteria. So all the project that have been evaluated, and your decision should be based on the IRR, sorry, on the NPV. And while making this decision, you should take other things like other conditions that are provided in the book in the question, like mutual exclusive, cut-off period, and so on. But your decision should be based on the NPV estimation. So apart from that, we discussed about the cash flows, how we generate the cash flows, how we estimate the cash flows in order to calculate the NPV and IRR and to come up with a certain decision in the case of expansion of the project. So today we're going to talk about the expansion project. We are going to touch the aspects of the expansion project, then we will move to the replacement cost. And apart from that, we will see how the cash flow projections will change with the different methodology of depreciation that have been used actually. So we said there is a way to calculate investment outlay. It's just capital expenditure that you have invested while starting your project, and you're adding up the increasing net working capital. So this both will give you the initial outlay, initial investment cost. And we said that the after-tax operating cash flow are used as a cash flow to estimate the NPV. And we've got here the way of calculation. I said it's just lining down the income statement approach. Is just sales minus expenses. You get the EBIT, earnings before tax, and then you subtract the taxes. Then you derive the income up after the tax, and you add the back the depreciation, which is the non-cash item. This is the reason why we are adding back. And then you get the after-tax operating cash flow. So when we get into the example, we'll get better understanding of how we estimate the cash flow, Now, let me open the Excel. I will start with the book, with the question which is given in the book on the cash flow projection. So here, cash flow for conventional expansion project can be grouped into investment outlays. So first we are grouping into three parts, okay? The cash flow projection in the case of conventional expansion project, like you have a project, let's say you're producing the bread, okay? And you want to expand your business. You want to open these different branches to produce the same bread or different line of products. So you want to make some expansion. So whether that works to expand or not your business, this is how we make some cash flow projection, and we can work on that. So expansion project can be grouped into investment outlays, after tax operating cash flow project life, and the terminal after tax non-operating cash flow. So the last part, it is when you terminate your project, when is the last year of your project. So this is the year that we consider actually. So in Exhibit 2.19, which is given in the book, gives an example of the cash flow for capital project and so on. So investment outlay include 200,000 of for fixed capital items. So our investment expenditure is 200,000, and the outlay includes 25,000 for non-depreciable land plus 175,000 for equipment that will be depreciated straight line to the 0 5 years. So the summation of this 25 and 175, it in total, like it makes 200,000, and it's straight line depreciation, straight line to the zero okay, over the 5 years. So the project life is 5 years. So investment in net working capital, investment net working capital is the net investment, the short-term asset that are required for the investment. So this is an investment receivable and the inventory needed, less short-term payables generated by the project. So in this case, the project required 50,000 of the current asset, but generated 20,000 in current liability. So we need to get the net working capital, which is 30,000. So in the total outlay at the time zero will be 230,000. Okay, but let's start it. So we've got the numbers that we really needed. Okay, so these two will give us 230,000 in summation. This is investment outlay. Okay, we're gonna add it up. Now we go to Excel. We start with investment outlays. Okay, the bolt. So it's investment, or let me put it in this way, fixed capital, fixed cap, and we have net working capital, NWC. I will abbreviate like this. So NWC is referring to net working capital. Okay, so we said this is 200,000 and this is 30,000. Like, let me dollarize it. Okay, and total investment outlay will be equal to, let me put it here, 230,000. Or but the issue in here, guys, it's a negative number. It's a negative number. We're sum it up. Okay, summation. We need to add them up together. Okay, two negative numbers should be added here. Two negative numbers should be added. So the function I used it here, sum, or I can make it in a different way. For those who are not familiar with the Excel function, I can make it my job, my aim in here, to make this investment cost together to show the summation in total how much they're gonna be incurred if we go with this project. So this plus this. Okay, two negative numbers should be added. Two negative numbers should be added. But it's negative number. Why it's negative? Because it's investment cost that we incur. This is what we start with, actually. Then we proceed with the question. So investment we said we are using this number and we're using this number. So each year the sales will be 220,000. So each year we're gonna sell something at specific price for this amount. Cash operating expense will be 90,000. So the cost to produce something that we are selling will be 90,000. And annual depreciation for 175 is depreciable equipment, which is 1/5 of the cost, is 35,000. So every year it will be 35,000. 1/5 of the cost of this, the annual depreciation. Equally, it will be distributed from 1 year to till the 5th year. So the result in operating income before the taxes, we should get this number. We should get this number. And income taxes at 40%, we tax in, so the tax amount will be this. So this will leave us operating income of the tax of 57,000. And at the end, we'll add the back depreciation charge, depreciation non-cash item of 35,000. So our annual after-tax operating cash flow should give us 92,000. So this is our aim. So in here, they just explain how to do it, but let us go by Excel function. So my sales, so I have sales here, okay? Sales, I have cash operating expenses, and on the other side I have depreciation. Okay, so we said that our sales is going to be 220,000 every year, but in terms of the years, so this is 0 year, this is 1, this is 2, 3, 4, and 5. 5 years, okay? I have 5 years in here. Now, 220,000 sales cash operating. Then my cash operating expense is equal to 90,000. Okay. My depreciation is equal to 35,000, which is 1/5 of the cost, which is 175,000. It's directly given in the book. And of course, this will help us to get operating income before taxes, or sometimes we call it as EBT, earnings before tax, or we call it like operating income before tax. We call it in this way as well. So how we get it? From sales, we subtract the cash operating expenses and depreciation. We just subtract 90 and subtract the depreciation itself. So this is what we get, the EBT, earnings before tax, and the tax amount, tax is 40%, and the 40%, 0.40 times this amount, which is 38,000. My earnings after the cash, after tax operating cash, after tax operating cash flow, so this minus this. No, I think I should make it a bit bigger here to show it to you. So my ABT that I was finding is the first step that I find it, is from sales, I subtract cash operating expense, I subtract the depreciation, and I get EBT, which is earnings before tax, or operating income before the tax. Then I use the taxation of 40%, the 40% of the income which is paid before the tax. My tax amount is 38,000. To get the after tax operating cash flow, I should deduct from this amount the tax amount. So this is what I get it as well. Then at the end, as I told you, that depreciation is a non-cash item that should be added back. So our depreciation needs to be added back, 35. So when we add the operating cash, the depreciation back, so there's a thing that we're deriving, is the last thing that we are actually looking for, is the after-tax operating cash flow, final after-tax operating cash flow. So from here, we're gonna add the depreciation back, okay? So we got the operating cash flow. However, our job is to get total after-tax cash flow, So we have things that are called total after tax cash flows. Total after tax cash flows. So we just calculated for 1 year. We calculated just for 1 year. And apart from that, we need to calculate the terminal non-operating cash flow. Terminal, which is abbreviated as terminal non-operating cash flow. Terminal non-operating cash flow, okay? This thing that we need to calculate as well before just counting the total after-tax cash flows. But before calculating, I will leave this thing to the last moment, but I want to calculate all the cash flows for all year because we've got a project to last 5 years. So we need to estimate the project for 5 years. So if you come to the question, you see that each year the sales will be 220 and operating expense will be 90,000 and depreciation will be 35,000, which is 1/5 of the cost. So that means for simplicity, we're assuming that for all years, we're gonna have same cash flows. But in reality, in the real life, so we're gonna touch that project as well. In real life, we will have $220,000 in this year, next year is different, third year is different, fourth year is different, fifth year is different. Even the other things will change it even. We are not keeping the same, like cash operating expense might change, depreciation might be in a different methodology used, and so on. But for this case, for introduction, we assuming that it is fixed. Everything like for ceteris and paribus, nothing is changed, only we're just saying that the sales is the same. So sales throughout the years, same. Okay? 5 years, it's gonna be same. Cash operating expense, gonna be same. No changes, 90,000. Depreciation is a straight line depreciation, should be depreciated straight line to the 0 over the 5 years, which means that each year the depreciation cost will be the same. Okay, and the logic is applied in the same way. The logic is applied in the same way. Like to find EBT, earnings before tax, we subtract from sales the cash operating expense, or in other words, we call it as cost of goods sold. And then we subtract 35,000, which is depreciation cost, to get the EBT, earnings before tax. And for Excel, you just take your mouse, put it on this shell until your point gets a black cross, and then just press left click and just drag it to the right side. It will calculate automatically, or you can do it manually, like putting this formula. From here, subtract this, and step by step. But if you drag it, it will get you directly. And what is the best thing, what I like it in Excel, you can just select everything and drag it to the right, it will calculate automatically everything. Even the numbers could be different here, they still get the calculation correctly. So our tax is the same, 40% of the amount, no changes. If you have any question, please feel free to ask. Okay, so this is, we get it. After tax operating cash flow. I think it's just pretty easy, just a little bit longer. So that's why I ask you to use the Excel spreadsheet to make your job much more easier rather than using a financial calculator. Okay. But for simplicity, you may not use it. If you assume that all numbers are same, you will need to calculate only this part to calculate the NPV. You will assume that it's an annuity, that all things are the same, all the cash flows and expenses are same, so it will help you to. But if there is a cases that which is given in the book, They're not different. They're change as well. In the slides we have it, so they're changing from one year to another year. So we need to calculate using the Excel spreadsheet. And Excel spreadsheet will kind of open all the way that you use it to calculate it, and it will show you if you made any mistake in your calculation. You will be easily find it out. So the last thing that we do it in here is terminal non-operating cash flow. Okay, but to find that terminal non-operating cash flow, we need to know some additional information which is provided in the book and some questions. So here we use this one. At the end of the 5th year, the company will sell all the fixed capital assets. In this case, the fixed capital assets, including the land, are sold for 50,000. Okay, we are selling for 50,000. We're selling for 50,000. Which represent the gain of 25,000 over remaining the book value. So there's a remaining value, which is book value, okay? So there is a gain. There's a money we earned, actually. There is a gain we just generate, okay? So 25,000 we earned. So the gain, any earnings in the firm should be always taxed. So this 25,000 bucks is being taxed by 40%, which is given rate above as well. That results tax amount, which is 10,000. Okay, so this leaves, so how it works here, you sell it for 50,000. However, this amount, some part of this amount, gain part, will be taxed by 40%, which is 10,000. So it will get you to 40,000. It will get you 40,000. And apart from that, there's a net working capital investment, which is 30,000, is recovered in the short-term assets. So there, it's going to be added back. So we're going to add this net working capital 30,000 back in terminal year. So which is 70,000. Okay, you got the 70,000 in total. This is how it works. So general idea about the terminal non-operating cash flow, anything you sell it, if there is a gain, you have to tax it. So that tax amount should be deducted, plus any additional net working capital. If there is, you add it back. This will give you a terminal non-operating cash flow. The cash flow from non-operations, from not the cash flow that comes not from operational of the business. It comes just from the sale of the certain equipment or certain part of the project. So what we do here, we said 50,000, this is what we sell it, minus our gain is 25,000. That amount should be taxed by 40%. 25,000 is our gain. Plus net working capital, 30,000. And the last part that we were actually going to, it was total after-tax cash flows. So what is our investment cost here? We just get it here down. This is our investment cost. So what is our cash flows we are getting here? Drag it here. And the last year, we have this cash flow plus terminal and operating cash flow. So this is total after-tax cash flow that we have estimated. Now we can do NPV projection on this, the NPV estimation. Now we can calculate the NPV with some certain discount rate and we can calculate the IRR. So NPV with 10% discount rate and IRR. And the rest is the same. You know how to calculate the NPV in here. It's very easy. You just type it NPV. The rate we said is 10%. And the cash flows are here. You just get this range, close the bracket. And of course, you need to subtract the investment cost, which is here. I'm putting plus sign here because of the mathematical rule. If you put it minus and the minus number in here, minus, it will not subtract, but will add it. But for the purpose to make it subtraction, we need to put a plus sign here. Yes. And as I told you, when you type the function of the NPV in here, it just gets you present value of all future cash flows. And minus the investment cost, you should do it manually. So this is our NPV. And our IRR, still, IRR is easy to interpret. However, it has some pitfalls. But our reliance will be on the NPV. Our decision will be based on the NPV. So our IRR will select this, which is 32.70%. So this is we call, okay, book example. And let me just save it for the purpose to upload it. Cash flow projections. Example 1. Okay, I saved it. So this file, I'm going to upload it to the Moodle. You will have it in the Moodle. This file will be uploaded to the Moodle as well, with the video recording that I have it here. Do you have any questions? It's just straightforward. There shouldn't be anything that misguide you, but still, if you have any questions, please feel free to ask. But I'm gonna do it one more time with another example so that you can understand better. My question, please type it in the chat, yes or no. If I ask you now the same question, similar question, not the same, but similar question, will you be able to do it? Type it yes or no. Okay, great. So let us move to the question which is given here. So we are given here another question, but in the slides, they calculate everything manually. They calculate everything manually here. But the process is the same. There is no difference. here how we, so our job is to get this. Our job is to get this part. However, in here, the difference that they made is they used a different methodology, which is modified accelerated recovery cost methodology depreciation. So we may apply this, and we still can apply the straight line depreciation, and we can see what's going on. So here, suppose a company that has got opportunity to bring out a new product, vitamin burger, the initial cost of asset is 100 million, and companies, the working capital would increase by 10 million during the life of the new product. So the new product is estimated to have useful life of the 4 years, at which the time the asset would be sold for 5 million. The management expect the company sales increase by 120 million in the first year, 160. You can see that it's now different rates are used, okay? Different numbers in the sales. Third, second, fourth, 140 and the 50 million. And the fourth year, because of the competitor have fully launched a competitive product. And operating expenses are expected to be 70% of the sales. So it's just whatever we find it out, whatever we just put it, the sale, the operating expenses, the cash operating expenses will be 70% of that. And based on the asset life of 3 years under modified accelerated cost recovery system, macrs, we need to calculate the depreciation, which is very easy, If the required return is 80% and the tax rate is 35%. So having this information, we need to calculate MPV and IRR in order to come up with a decision whether the company should invest in this new product or not. So the previous example from the book, it was just expansion of the business. Now the example of the new product, whether the firm or investor should come with this new product or no. In order to do that, we need to make estimation of the cash flows. So the same way that we used to do it, okay? We're using same structure to calculate. So what you can do, you can just copy it, this, and I'm going to the second sheet here, put it here, everything. So now, initial outlays, bring it down, and the number of the years are actually 0, 1, 2, 3, and 4. 4 years, okay? We've got here 4 years instead of 5 that in the previous example. Now, investment outlays in here, which is 100 million, okay, which is 100 million. The change in net working capital, which is 10 million, and the summation of it will be this much. Let me make it bigger, okay? So, I'm sorry. Initial outlays, make it down there, like this. Okay, our total investment cost is equal to 110 million from the information that I get it here, okay? 100 million, 10 million. And at the last year of the project, at the year 4, they will sell the asset, and the price for that asset will be 5 million. So they will get some money on that, 5 million. We're gonna treat this 5 million as well, okay? So they are selling, so they're making some money on this 5 million after the depreciation, the whole amount. Now, and it said that sales is going to be in the first year 120, in second year will be 160, in the third year it will be 140, and the last year it will be 50, okay? So this is the sales. In the first year is 120 million. Second year, it will be 160 million. Third year, it will be 140. Fourth year, it will be 50. Yeah, let me just make it. These are all dollarized, okay? And we know that cash operating expense is 70% of the sales for the corresponding year. So this amount times by 70%, you will get the cash operating expense. And it's the same for all years. Okay. Depreciation, we can use straight line, but then we can use, but we are asking the question to use modified accelerated depreciation rate, okay, for the 3 years under macro. So there is a table here. So we need to use this table, okay, this part. So this is the that we need to get adhered actually while calculating the depreciation, okay. So this is our macro calculation. So what is our cost? 100 million. So in the first year, it is 33% of the 100 million. So 100 times 0.3333. In the second year, our depreciation is 44.45% out of 100. Hundred times 0.1481, and the last year 100 times 0.0741. So this is the depreciation that we calculate. Our EBIT, earnings before tax, which is the easiest part, 120 minus cost minus this. We get it, okay? Then the tax amount, 40%, no, it's not 40, which is 35%. So 0.35 times here, but here we should change it as well, at 35%. And after tax operating cash flow, from here we subtract the tax amount, drag it, depreciation added back. We are adding back the depreciation amount. And we are getting after tax operating cash flow. This plus depreciation. So we got it. Now the turn comes to calculate the operating cash flow. So the terminal non-operating cash flow. So we calculated after tax operating cash flow. Now we can get the total investment cost, but before getting it, we need to calculate the total non-operating cash flow. So if you remember from the question, it said they sold the asset for 5 million. Okay, they sold it for 5 million. So they made some profit on it. This is the gain. So this 5 million should be taxed. So salvage value minus tax amount plus change in net working capital. So are we going to close answer? Yeah, yeah. We're more or less the same. Yeah, exactly the same. Exactly the same. So total non-operating cash flow is 5 million minus 5 million times 0.35, and of course plus we have change in net working capital, which is 10 million. We are going to add it back. So our total non-operating cash flow will be equal to 13. So 5 million, the asset we're selling, and 5 million should be tagged at 35%, and plus we're adding back. Okay. So total operating cash flow is salvage value minus tax amount and plus net working capital. But the tax amount of the salvage value, okay? Tax amount of the salvage value. Total after-tax cash flows. Let's see it. This, plus this. Let's check it. So total operating cash flow here, they calculate it. And our total after-tax cash flow are here, exactly same. You can do it manually, the discounting at 8%, then add them up and subtract the investment cost. And once you're doing Excel, then it's better to use the NPV function. But here with difference, it's not 10%, it's 8%. Okay. So our NPV, open the bracket, rate is 8%. Select the range, close the brackets, minus the investment cost. So our NPV is positive, which is 7.15 million. It's a good sign. And IRR, we can calculate just selecting the range. Which is 11%. It's not 11, but let me make it 11.07, okay? So the IRR 11.07. This is
Sorry, Professor.
Yes, please.
Could you show, please, NPV again, formula?
Yes, sure. I'm gonna put it here like macrs, and here I'm gonna put it straight line. So I'm gonna do the example with the straight line. Gosh, it doesn't work. Okay, you know the best thing what I can do? I'm gonna send you now this file, or let me upload this file to the Moodle. You download it and try yourself now with a straight line. Okay? But this one is not correct because our depreciation method will be different here. I want you to try yourself. You need to just put the depreciation here. I will upload it and you try it yourself. Or the best thing that I can do, send it to the group chat. Anyone who has an access to the computer, please feel free to do it. But who is using the mobile, next time you should be ready to use such things. Okay, now, it was in fall 2020, corporate finance. Okay. Cash flow projection example 1. Okay, I'm gonna send it to chat. Okay, file cash flow successfully sent. Now everybody should have this file. And this file will be uploaded. You can just open it and try with the depreciation straight line methodology. While you're doing it, I'm turning off the screen sharing. So I want you to show me yourself what you have achieved until now.
Sorry, did you send to this chat?
Yeah, I sent to the chat. I sent to the chat.
I
sent to the
didn't
chat.
see it. I cannot see it.
Please. Can anyone who cannot see it?
Zoom chat.
Zoom chat, not the WhatsApp group. I'm not in your WhatsApp group.
Yes, Zoom chat, and maybe something wrong with internet, but I didn't get any messages from you in Zoom
Then
chat.
wait 1 minute. I will upload it to the Moodle.
Okay.
I'm gonna upload it to the Moodle then.